I'm here to speak about the North American Income Trust. As the name suggests, it is income focused, it is North American focused. I will try to be brief so we can get to some questions here. And let me move to the next slide. So North American Income Trust, this is sort of our high level, what you're buying, what you're looking at for this trust. It's very much a best ideas portfolio, 35 to 40 stocks, dividend yield, roughly 3.7%. I think importantly, that's not a stagnant dividend yield, it's one that's growing. Historically, it's grown 7-8%. Over the trailing year, we're right in that ballpark. We're roughly 6 to 7% annual dividend growth. And since conversion of the trust 12 years ago, we've been able to grow that dividend 7-8%. We've also been able to take our revenue reserves from essentially nil over that time period to over a year. So a very healthy balance sheet as far as revenue reserves, dividends. All the stocks in the fund do pay a proper dividend, and it is growing. Gearing, fairly modest. We have a small facility. Net gearing tends to be in the low single digits, so not a heavily geared portfolio, but something where there is a facility that we were able to secure a nice low interest rate and be able to do so. Options, we use options sort of more in a surgical fashion. This is not a covered call portfolio. We're not trying to engineer a higher yield through the options market. Really what we use the options market is to either write a put to buy a stock a bit more cheaply, or to write a call to sell something, a bit out of the money and accrue a little bit of extra income. We can also, and often do, just go to our cash desk and trade those stocks if need be. But once we come to that decision of topping up a name or perhaps top slicing a name, we have two means to do it, and we'll sort of do it in a pretty sensible, disciplined manner. So every once in a while, we'll write a few options to reduce a position or expand one. And then finally, next generation dividend hero. We've been able to have a progressive dividend, a covered progressive dividend with the reserves. And we reached 12 years recently, in the 12th year anniversary of fund conversion. And when we look at the stocks in our portfolio, they very much continue to pay that 3.5–4% dividend, growing at that mid to high single digit rate. So we expect that track record to continue. Next slide, please. And again, here's our dividend policy. I know as we heard a speaker earlier talk about quarterly dividend payments, we've always done quarterly dividend payments, and then we have a final dividend payment. And because we're in a January fiscal, our final dividend payment has not yet been announced. It'll be announced shortly, typically in early April. But the final dividend's usually, a third, maybe 30% of total revenues of the total dividend payment. So we expect to continue our streak this year, and we believe that the stocks in the portfolio give the board of directors a position to continue this. But again, very predictable, very transparent, and we like to continue this bar chart. I think it's something that we're very proud of. Next slide, please. Why the U.S. for income? Obviously, we know about the Magnificent Seven. We understand the capital abilities of U.S. companies. And I think when you look at this fund, we talk about the importance of dividends, but I think, stepping back, this isn't a utility and telecom and REIT heavy fund. This is very much a growth and income fund. We're looking for good quality companies that are cash generative, have the ability to grow their business. We're not looking for companies to spend every dime just to meet a dividend payment threshold. We're looking for companies that invest properly in the business and then return surplus funds to shareholders. And in this chart, it just simply put in the last decade to date, in the 2020s, and even the prior decade, given a very unique set of circumstances with monetary policy, with pretty much a zero interest rate policy for the bulk of this time period, you saw capital be a much more important way of returning value to shareholders in the stock market. We think with higher interest rates and what we believe higher for longer, we think that a more balanced dividend contribution to total return will be more significant going forward, given these sort of higher discount rates where shorter duration equities are more advantaged. Next slide, please. And this just simply shows the dividend return. It's really a pie chart of the prior slide, where dividends have been a much smaller piece of total return in the last 10 years versus history. Dividend returns are typically anywhere between a third and 50% of the US market. We think that sort of range is normal over time, with a normal backdrop, a normal inflation, a normal interest rate environment. And I think going forward, we'll look back at these last 10 years as being a bit unique with the zero interest rate policy, which is largely, no longer in process. Next slide, please. Dividend growth continues here. And I think what's important for this slide, and given the UK investor base, what we saw during COVID and during the pandemic in 2020 is, you can see it, and I hope that this shows up big enough for you, but there were some suspensions, there were some decreases in dividends, but generally you've seen a growing dividend for US companies. And I think what is important in this portfolio, the North American Income Trust, is a sort of a high quality cash generative trust. During the pandemic, of our 37 stocks, we only had one dividend cut. And quite honestly, it was a 14% dividend cut. We still own this company today, and the dividend payment is considerably higher than it was even prior to the cut. So dividends continue to grow in the US market. The headline rate is not quite as high as you may see elsewhere. But again, in this portfolio, you're seeing a 3.6, 3.7 underlying dividend yield, again, growing 6 to 7%. Next slide, please. And here's valuation. It's the market in the US is incredibly bifurcated. Growth and value, valuations for value stocks, and which is a general subset of dividend stocks, very lowly rated. The Russell Value Index is trading on roughly 15, 16 times forward earnings, whereas if you look at the growth index, trading 28, 29 times earnings. So that's much wider than the historical gap. And we never claim for mean reversion or give you a timetable on mean reversion, but I think the odds are sort of tilted in our favor. And I spoke about higher interest rates, higher inflation, which should benefit value stocks. And I think when you look at the North American Income Trust, we're actually only trading on 14 times forward earnings. So we think we're paying a very fair price for high quality companies that continue to grow the business and are cash generative to pay that progressive dividend. Next slide, please. And again, this is sort of the flip side of the valuation side. This is total returns. So it shows growth versus value, well above long-term trends. I think, stepping back, we understand why that would be in a zero interest rate environment where you're sort of incented to take on risk, and, future cash flows are discounted, by zero. I think that we understand the thought process behind that. Again, we think going forward, we're very well positioned. And then, when I look at sort of decade to date, as I looked at sort of total returns, value has underperformed growth by 55 percentage points since the start of the decade, which is really amazing, for such a short period of time. And I think that, again, these stocks are very well positioned, and we're paying a fair price for the stocks in our portfolio. Next slide, please. This is just sort of a total shareholder yield of the US market. The US market's often thought of as a low yielding market, and by dividend yield, that's factually correct. The S&P dividend yields roughly 1.5%. If you include buybacks as part of a total shareholder yield, you get something just north of 4%. And then that light blue bar, that teal bar at the bottom, just sort of shows stock issuance. So if a company issues some shares to employees as sort of compensation, that obviously increases the share count. But I think when you look at the total shareholder yield of the US market, a roughly 4% yield is actually fairly, robust. And I think that when you look at the North American Income Trust, what you would expect is we don't have the 1.5% yield of the S&P. We have something that's more than double that. I mentioned 3.5 to 4%. And our companies also are not big buyback companies, but they tend to at least buy back the amount of stock that they issue to employees. So they keep the share count flat on average while paying that healthy dividend. Next slide, please. Why the North American Income Trust, and we can continue. What do we mean by quality investing? This is sort of the Aberdeen generic slide of quality, the components that we think are important. I think the biggest takeaway from here is we're not always looking for stocks that at the start of the year we expect to double or triple. What we're really expecting is methodical growth, consistent growth, transparent growth. Management teams that have gone through the tough times have the ability to grow through that. And that's sort of the hallmark of our investment process. And sort of if you look at our underlying holdings, you would see that very much. And what we're trying not to do is to avoid blowups in companies that are growing too aggressively, don't have the wherewithal to continue to grow. And when things stop, when the music stops, they're not well positioned. We're not looking for those types of companies. We're looking for a bunch of consistent growers across sectors, across industries. Next slide, please. This is our top 10 holdings. Because it's a best ideas portfolio, the top 10 holdings are typically at least a third of the portfolio, if not upwards of 40%. And typically these are long-term holdings. These are companies that we have high conviction in, and we believe over time are well positioned, and a fairly diverse group of stocks within the portfolio. Next slide, please. This is our sector map. We just show our sector breakdown. Again, a diversified portfolio. If we find a sector that we think is too expensive, we think industrials are a bit expensive now, we're underweight the industrial component of the portfolio. Conversely, a year ago, if you were to look at this slide, we actually had a zero weight in utilities. Utilities were trading at roughly 25 times forward earnings, which we deemed, far too high. And a year later, in our portfolio, and our portfolio is not a high turnover portfolio by any means, but we actually have a modest overweight in utilities right now. So it's something where, we'll take what the market gives us. If the market overprices something, we have to step back and look at the portfolio and make the right decisions for our shareholders. And valuation, while valuation may not have been important with zero interest rates and whatnot, we believe that going forward, valuation is going to be a lot more important given the higher cost of capital and given that the capital is not as easy to get as it once was. So if you look at these companies, again, cash generative, often self-funding, those are the type of companies we think are well positioned going forward in this environment. Next slide, please. These are initiations and exits over the past 12 months. And typically, I think it was mentioned earlier, just because you have a good company doesn't necessarily make it a good stock if the price is too high. So I think that we need to, be disciplined on that front. And Home Depot is one that you would know, a very high quality company, mortgage rates going through 7% here. Typically when you go to Home Depot, it's right before you buy a house or right after you buy a house, when you're fixing up your house to sell or when you're buying a new house. And given that backdrop, Home Depot, a very high quality company that tends to trade at a full valuation, was no longer sort of a top 40 idea for us. So those are the exits, where we would agree that they're good companies. We would put them on a watch list, but not always the best stocks. And the ones to the left are ones that we thought were better positions, that had a combination of growth and income at fair valuations. Next slide, please. And this is the dividend yield of our trust. I mentioned a few times now, dividend yield is roughly between 3.5% and 4% of the underlying holdings. And I think importantly, we have no hard and fast rules of it needs to be a market yield or better, but typically that's what you see in this portfolio. What we're not trying to do is have a bunch of high tech fast growers with no dividend payment and have a whole bunch of 8-9% yielding REITs or telcos or utilities and try to sell that as a dividend portfolio. This is very much a proper dividend portfolio where companies allocate a portion of their free cash flow to dividend payments, returning that money to shareholders and sort of growing that in a prudent fashion. Next slide, please. By now, next slide. The investment outlook. I think, when we looked at 2023, the most predicted recession ever, we didn't see that. So that was a very unique time period. Right now, the Aberdeen House View is calling for a shallow recession this year. I would tell you, the U.S. market is not pricing in that. When we talk about the market being expensive, as we did earlier, the S&P, I gave you growth and value. The S&P is trading at roughly 21 times forward earnings. This portfolio is roughly 14 times. But I think you do need to be careful. I think there are pockets of value in the U.S. market that I think that we found in this portfolio. But GDP, we're going to see how that plays out this year. But a recession is certainly a potential and the potential outcome going forward. Inflation and interest rates, higher for longer has been a mantra of ours. Interestingly, when we said that early, we thought that a higher interest rate backdrop would be more favorable for value stocks. That hasn't been the case over the past year, but we think, again, going forward, we're well positioned. And then the driver is employment, and employment still remains very full, sub 4% unemployment, which is very rare. at this part of the cycle, but nonetheless still exists. We need to be careful and not look at that as glass half full, but potentially glass half empty. If unemployment goes from the high 3% range to something in 4.5%, do we have a portfolio that's be able to withstand that type of shock to the system? That's a risk in the U.S. market. It's not a risk today, but it potentially could be a risk later this year. We can go on the next slide, please. And this is just talking about the dislocation, what we believe is a dislocation between inflation and interest rates. And we show inflation here, roughly 3%. It's obviously down from that high single digit rate, the exaggerated rate we saw at the beginning coming out of the pandemic, but still a well above trend 3.5% type rate, compared to historical rates over time. But it's something where the Fed has talked about inflation going toward 2%, but if you step back at roughly 3.5%, the forward earnings multiples of 21 times, quite high for something at 3.5%. Typically, you would assume a 21 market multiple on an inflation rate, maybe in the 1.5 or 2% range. So there's a little bit of a dislocation there. Again, we've been very selective in our holdings, roughly, that 14.5 multiple of our holdings. But we're very cognizant, and obviously inflation is something that has remained sticky. We think will continue to be somewhat sticky, but we're cognizant of the risks and rewards that would provide. And obviously the Fed is there, feeling a bit more dovish lately, apparently. So something to consider in investing in the U.S. market. Next slide, please. And this is just an interesting checklist, and it's probably something that when we send you the slides, it's an interesting read. It may not be real easy to read on a screen right here, but when we look at the sort of the mileposts, are there any yellow flags in the economy for a recession? These are the ones that we would typically look for. These are ones that you've seen historically, and right now, very few. The yield curve remains inverted. That's obviously subject to change, but right now it's been a very long inversion. It's not a big inversion, but an inversion nonetheless. But if you look at many of the other indicators, the economic indicators, they're not flashing yellow right now. I wouldn't call them bright green, but they're in a nice spot, and the Fed feels pretty confident they can engineer a soft landing. We'll find out later this year, but right now the recession, signposts are generally in a favorable position, albeit something as a fund manager we need to be cognizant of the risks. Next slide, please. And then here, this is a different slide, interesting one. It's a bull market checklist, and it shows sort of, again, signposts of what happened at the top of the market in 2000, what happened at the top of 2007. Are we seeing similar things now? And as you can see, we're not. So, we do know that valuations can be fairly full, especially in certain pockets of the market. But broadly speaking, you're not seeing the typical hallmarks of a overheated, ready to turn over bull market. So again, this is sort of the bull case. This is why the U.S. has been fairly strong. We've talked about employment, being at strong levels. The economic signs are not there. The typical market indicators of a bull market, as we show on this slide, typically not there. But again, we need to be sensible as fund managers. We have, shareholder capital to be stewards of. And I think for us, finding that right balance of growth and income and paying the right price for that is very important in this market. Next slide. And then the summary page, why the North American Income Trust. I think that, when you buy this, you're buying a high quality, portfolio of cash generative companies. I think that when we look at how this is managed, it's managed in a very, risk aware manner. We're valuation sensitive. It's a very much a research driven portfolio. We've talked about why value has remained out of favor. We think with higher interest rates and higher inflation, I think there's be a much better balance of growth and value and how those stocks are valued, given much higher discount rates. And I think that, we continue to find those best ideas, those ones that are growing capital, growing the revenue streams that we access via dividend payments, and we expect to continue that going forward. So thank you very much for your time. I know it's late in the evening, but I'm more than open for questions.
Fran, thank you very much indeed. And let me get the questions up on my screen here. Okay. Okay, the first question was about options. You mentioned at the start. As a British investor with a limited knowledge of options, could you just give us a bit of an overview of the kind of the risk introduced by the use of options,
Yeah,
how they work?
Yeah, options, or if I want to use the word derivatives, obviously can have a negative connotation. I would tell you our usage is incredibly vanilla. An example I would typically give, if we have a stock that's done well, we'll say it's $98, and we want to say trim 50 basis points and redeploy that elsewhere. We have two ways to do that. We can send that order to the trading desk, trade that 50 basis points, sell that to the market, and sell that 50 basis points at $98. Or we have an alternative. We can write a call, we'll call it a $100 call, so something $2 higher, and typically we'll get paid $1.50 or so for that. So we'll have the ability to write, to sell that stock at $100. We get paid $1.50 to do that. So we feel comfortable. The stocks we would do that is where we feel comfortable about the fundamentals. Valuation is is fair, but perhaps a little bit high, which is why we're looking to trim it in the first place. But we'll get that extra income, and if the stock goes to $100, we'll lose that 50 basis points. Of course, the risk there is the $98 stock goes to $90, and we could have sold it. So that's something that we very much weigh on the front end. What are the risks of the stock here, and what's the best way to modify and construct a portfolio? So again, it's a handful of positions on a 40 stock portfolio. So it's nothing that it's going to drive the portfolio. We're not going to come here and say we outperformed because of our options or we underperformed. But it's sort of a sensible tool for portfolio construction where it makes sense.
Next question is about dividends and buybacks. As the trust manager, does it make any difference to you whether a company pays via dividend or via buyback? What other devices, I guess, would tell you?
Yeah. So what you'll see in the U.S. market, and you would appreciate this, is when companies are flush with cash, they're more apt to buy back stock, and when they're flush with cash and more apt to buy back stock, the stock tends to be higher. So the track record of buybacks has been spotty because of the sort of pro-cyclical nature of buybacks. We're not against buybacks. I think what we like is getting that cash returned to us, and then we can allocate it as we both see fit. What we typically see in the U.S. market, and I mentioned earlier, is you'll see some companies, and again, I'll use an example. If a company has 100 shares of stock outstanding and they issue, 1 share to employees, it's usually a little bit less, but they'll typically buy back that and in the year at 100 shares and keep their cost of capital low. They don't want to dilute the equity shareholders, but they want to incent the employees. Those are the companies we're looking for. Companies that maybe keep their share count flat on average, pay that proper dividend. And importantly, from a fundamental perspective, we want our companies to invest in the business, but we don't need them to chase, a dozen projects. We want them to focus on the top 4 or 5 projects that they have the best return on investment, the lowest risk, highest chance of success. And then, focus on those. Don't try to focus on a dozen different things, and then return that surplus cash to shareholders.
Next question, and we had one mentioning elections before, another one on elections. Does it make any difference, do you think, if there's a change in administration? Can you plan for that at all, or how do you plan for that?
Yeah, so we try to keep an all-weather portfolio, which is an easy thing to say. In reality, and I'll apologize for our 2 candidates in advance, but when we look at it, and obviously you sort of probability weight some things, and the market's forward-looking. It's we know what the polls would lean Republican right now. And we would probably just consider it a toss-up. It's far too early to consider that. I think what may be instructive is the Senate map. In the Senate, the senators, which is part of the Congress, they're reelected every 6 years, and so you typically see a third of them come up for election every year. And this year, and the Senate is slightly tilted Democratic right now, but the way the map sort of shakes out, it's very much a Republican-favored Senate this year. So probably the easiest betting odds, if one were to wager, is a Republican Senate, which theoretically takes a Democratic sweep off the table. Again, far too early, but something, directionally what we think we're seeing. And what it does do is it theoretically would put a Republican sweep in play. So those are the 2 extremes. And those are, when there's a Democratic sweep or a Republican sweep, that's when you can see some aggressive changes. That's when you saw Trump get his tax rates through. That's where you saw Biden get through some legislation. We saw Obamacare, get through. So in a divided government, if the Republicans were to win in a divided government, yeah, there would be some incremental change. There's some things the president can do unilaterally. But from a market perspective, there's probably a few sectors that would benefit under a Republican versus a Democrat, whether it's financials and energy, in a Republican type backdrop, and obviously more environmental type issues for Democrats, and probably a little more regulation, which perversely limits energy growth at times. So you do see sort of a, bad intentions come out of honest legislation. But, I think the sweep is where you see the extremes. And for the Democrats, it's much harder to see a sweep, all else equal, at this point of the game. Don't quote me that now, because there's a lot to happen in the next 6 months.
And then we've got a final question, please, Fran. How do you generate ideas for the fund?
Yeah, so we have both a senior portfolio management team, sort of an income pod that feeds up to a global income pod. So we have that, and then we also have the researchers, on the ground floor, boots on the ground, and it's sort of a combination of that. So, always looking for new ideas. We do have sort of generic screens looking for ideas. As you can imagine, given our quality threshold, we kind of have a good idea of our universe, roughly 250 stocks to sort of meet that high level threshold. And then once we dig deeper, we cut that list, by more than half. And ultimately we create that sort of 40 stock best idea portfolio. So very much a collaborative effort. The US market, and we're not looking at micro caps or even really small caps. So we're looking at, mid caps and large cap stocks. And these companies, are obviously, they have analyst coverage. We see them at conferences. They're very easy to access. Obviously, companies are always looking to talk to long-term investors like ourselves. So that part, finding these companies, we know we sort of know where they are. They're easy enough to find. It's our job to make sure we pay the right price for them and understand the risks.
Lovely. That's great, Fran. Thank you very much indeed for presenting, and thank you again for being patient and right. We started a bit late. I do appreciate that.
Thank you. Take care.